If you're watching this in January 2026, you're being told everything is fine. The Dow just hit new highs. Unemployment is at 4.2%. The Fed says inflation is under control. CNBC is running segments on the resilient economy. Goldman Sachs is forecasting another year of growth. They're lying to you. Not because they're malicious, but because they're trapped in the same psychological blindness that has destroyed wealth for 224 years, every 18 years, like clockwork, with mathematical precision. The year was 1990. The economy looked invincible. The Cold War had just ended. America had won. The stock market was climbing. Real estate was booming. Everyone said, "This expansion is different. We've learned from the past." Then the savings and loan crisis hit. 747 financial institutions collapsed. $160 billion in losses. Recession followed immediately. Millions lost their homes. The invincible economy shattered in 18 months. Now here's what nobody told you. That crash was predicted, not by psychics, not by doomers, by a pattern so precise it had already called the crisis 18 years before that in 1973. And it was about to call the next one. 1990 plus 18 years equals 2008. In 2006, the economy looked invincible again. Housing prices only go up, they said. Subprime mortgages are safe, they said. Bear Stearns is fine, they said in March 2008. 6 months later, Lehman Brothers collapsed. $10 trillion in wealth evaporated. The worst financial crisis since the Great Depression arrived exactly 18 years after 1990, exactly as the pattern predicted. One man saw it coming. Economist Fred Harrison publicly warned in 2005 that 2008 would bring catastrophe. He was mocked, called a fearmonger, dismissed by every mainstream institution. Then he was proven exactly right. How did he know? Because he had discovered something terrifying hiding in 200 years of economic data. A cycle so consistent, so mathematically precise, that it has predicted every major financial collapse since 1800. The 18-year real estate cycle. And right now, in January 2026, we are 18 years past 2008. We're not at the beginning of this cycle. We're at the end. We're in the collapse phase, the 12 to 24-month window where the entire system breaks. I'm going to show you something that will fundamentally change how you see this moment. Not opinions, not fear-mongering. Historical patterns that have repeated with clockwork precision for over 2 centuries. Patterns that called 1973, 1990, 2008, and are now screaming that 2026 is when everything implodes. This isn't just another recession prediction. This is the story of how complexity kills civilizations, how debt traps destroy empires, and why the very systems we trust to protect us are the ones that guarantee our collapse. Because here's what terrifies me most. We're not just facing an economic downturn, we're facing the simultaneous collapse of real estate, stocks, consumer debt, and sovereign debt, all amplifying each other, creating a cascade failure we've never seen at this scale. Let me show you why ignoring this pattern in 2026 could be the most expensive mistake of your life. The 18-year real estate cycle isn't a theory. It's a documented pattern discovered by economist Fred Harrison when he studied land values and credit cycles going back to the 1800s. What he found was shocking. Economic collapses don't happen randomly. They happen on schedule. Here's the precise structure. Year 1 to 7, the recovery phase. Coming out of the previous crash, prices are depressed. Smart money, the people who understand the cycle, buy at the bottom while everyone else is too scared to enter the market. Banks are traumatized from the last crisis, so credit is tight. Growth is slow, steady, boring. This is when fortunes are made by those paying attention. Years 8 to 14, the expansion phase. Confidence returns. Prices rise steadily. Credit loosens as banks forget the pain of the last crash. Development accelerates. Construction cranes fill city skylines. Everyone who bought in the recovery phase is now rich on paper. This is the safe period where it seems like everyone makes money and the good times will last forever. Years 15 to 18. The blow-off. Top pure euphoria. Prices go parabolic. Credit explodes. Everyone who was cautious for the past 14 years now panics that they're being left behind and jumps in at the worst possible moment. Speculation dominates. Reality TV shows about house flipping. Your Uber driver is giving you real estate investment advice. This time is different, becomes the national mantra. Then, right around year 18, the music stops. Not gradually, suddenly. Then, the collapse. Within 12 to 24 months after the peak, the crash arrives. Prices crater, banks fail, recession hits, unemployment spikes. The people who bought at the top lose everything. The cycle resets. And 18 years later, it happens again. Let me show you the receipts, because this isn't speculation, this is documented historical fact. 1973 peak, 1974 to 75. Recession. Real estate peaked in 1973. The oil crisis triggered the collapse. Stock market crashed 48%. Unemployment hit 9%. Recession lasted 16 months. The pattern was running. 1973 plus 18 years equals 1991, 1989 to 1990. Peak 1990 to 91 recession. The savings and loan crisis destroyed 747 institutions. Commercial real estate collapsed. Stock market fell 20% in 3 months. Unemployment jumped to 7.8%. Recession arrived exactly on schedule, 18 years after 1973. 1990 plus 18 years equals 2008, 2006, 2007. Peak, 2008. Financial crisis. Housing peaked in mid-2006. Subprime mortgages started failing in 2007. Bear Stearns collapsed in March 2008. Lehman Brothers filed for bankruptcy in September 2008. Stock market crashed 57%. $10 trillion in wealth vanished. 8.7 million Americans lost their jobs. The worst financial crisis since the Great Depression arrived exactly 18 years after 1990. Fred Harrison, the economist who discovered this cycle, publicly predicted the 2008 crash in 2005, 3 years before it happened, based solely on the 18-year pattern. He was ridiculed. Financial institutions called him irresponsible. The media dismissed him. Then 2008 happened exactly as he predicted. Now, Fred Harrison is warning about 2026. And this time, the structural imbalances are worse than they've ever been. 2008 plus 18 years equals 2026. Do you see the pattern now? But wait, you might be thinking, didn't we have COVID in 2020? Didn't the market crash then? Doesn't that break the pattern? No, that's actually proof the pattern works. Every 18-year cycle has a mid-cycle disruption around year 11 to 14. It's a recession scare, a correction, a moment where weak players get shaken out. But it's not the final collapse. It's a fake-out, a head fake before the final blow-off top. Look at the previous cycle. The 1990-2008 cycle had its mid-cycle disruption in 2001, the dot-com crash. That was year 11 to 12 of the cycle. The market corrected 49%. Everyone thought that was the big crash. But real estate kept climbing. The cycle wasn't done. The real collapse came in 2008, right on schedule at year 18. Now look at our current cycle. Started in 2009 after the 2008 crash. COVID hit in 2020. Year 11 of the cycle. Market dropped 35% in 1 month. Everyone thought that was the crash, but the Fed printed $5 trillion. real estate went absolutely vertical from 2020-2024. Home prices rose 40% in 2 years. That wasn't recovery. That was the blow-off. Top. The mid-cycle disruption doesn't break the pattern. It confirms it. COVID was the 2020 version of the 2001 dot-com crash. It cleared out weak hands and set up the final euphoric phase. And that final phase? We just lived through it. 2020 to 2024 was the most spectacular real estate bubble in American history. Prices that defied gravity. Bidding wars where houses sold $100,000 over asking in 48 hours. Wall Street buying entire neighborhoods. Everyone said it was a supply shortage that would last forever. That was the blow-off top. Year 15 to 16 of the cycle. Right now, in January 2026, we are 17 to 18 years into the cycle. We're past the peak. Sales volume has collapsed. Inventory is rising. Prices are rolling over in major markets. The smart money has already exited. We're in the danger zone, the 12 to 24-month window where the collapse accelerates. And just like in 2007, most people don't see it coming. The data lags. They're looking at yesterday's prices while tomorrow's crisis is already baked in. Why 2026 is different. The Four Horsemen. Here's why this cycle's collapse will be worse than 2008. In 2008, we had one asset class imploding: residential real estate. Banks failed, but the government could step in. The Fed had ammunition. Debt to GDP was manageable at 65%. In 2026, we have 4 interconnected crises happening simultaneously, each one amplifying the others, creating a cascade failure the system cannot absorb. Let me show you the 4 horsemen of the 2026 collapse. Horseman 1. Commercial real estate. The silent Lehman, $1.5 trillion in commercial real estate debt, must refinance in 2025-2026. Not should refinance. Must. These loans are coming due. Here's the nightmare math. A building financed in 2021 at 3% interest now refinances at 7%. That doubles the monthly debt payment, but office vacancy rates are at 20% nationally, 35% in San Francisco. The building is worth 40% less than 2021. The payment doubled. There are no buyers. What does the owner do? They walk away. They hand the keys to the bank. It's called jingle mail. You mail the keys back and disappear. We're already seeing it. Not from small landlords, from institutional players with billions in assets. Columbia Property Trust walked away from their San Francisco office tower. Brookfield defaulted on 2 Los Angeles towers worth $800 million. RXR Realty stopped payments on a $240 million loan on a Manhattan skyscraper, $1.5 trillion in loans. If even 20% default, that's $300 billion in losses hitting the banking system. Lehman Brothers had $600 billion in assets when it failed and nearly destroyed the global financial system. This is half a Lehman. And we're just getting started. The 18-year cycle doesn't just predict residential crashes, it predicts credit cycle collapses. Commercial real estate is where the dominoes start falling. Horseman 2. The everything bubble. When concentration kills the Shiller P/E ratio, the most reliable long-term valuation metric is at 40. That's the second highest reading in 140 years of data. The only time it was higher? December 1999. Right before the dot-com crash erased $5 trillion. But here's what makes 2026 exponentially more dangerous than 2000. In 2000, the bubble was isolated to technology stocks. You could avoid it. You could own value stocks, bonds, real estate. Diversification worked. In 2026, the bubble is everything. The Magnificent Seven: Apple, Microsoft, Amazon, Alphabet, Nvidia, Meta, Tesla now represent 32% of the entire S&P 500's market value. 1/3 of America's stock market is 7 companies. If those 7 stocks correct 30%, the entire index collapses. That's not diversification. That's concentration risk masquerading as a safe index fund. And make no mistake, the AI bubble is following the exact same script as the Internet bubble: revolutionary technology, real productivity gains, parabolic stock prices. This time is different. Retail investors mortgaging their houses to buy in. The Internet was real in 2000. Amazon was real. Google was real. E-commerce was the future. They were right about the technology. But Amazon still crashed 95% from its peak. It took 9 years to recover because valuations were insane. AI is real in 2026. The technology will change the world. But Nvidia trading at 70x earnings? That's not valuation. That's religious conviction. When the 18-year cycle peaks, speculative assets crash first and hardest. In 1990, it was junk bonds. In 2008, it was mortgage-backed securities. In 2026, it's AI stocks and crypto. The cycle doesn't kill the technology, it kills the valuation. And when these 7 stocks fall, they'll take your diversified index fund down with them. Horseman 3, the sovereign debt trap, no ammunition left. Here's the number that should terrify you: $1.2 trillion. That's what the U.S. government paid in interest on the national debt in 2024. Interest payments are now the second largest line item in the federal budget, behind only Social Security. Bigger than defense, bigger than Medicare, bigger than everything except checks to retirees. We're now spending more on interest than on the entire military of the most powerful nation in history. And here's the doom loop, the inescapable trap we've walked into. High debt requires constant borrowing to pay old debts. Constant borrowing floods the bond market with supply. Excess supply raises interest rates. Higher rates increase the cost of the debt. Higher costs require even more borrowing. More borrowing raises rates further. Return to step 1. It's a spiral with no exit. And we're accelerating into it. The national debt is $36 trillion and rising $2 trillion per year. In 2008, it was $10 trillion. We've more than tripled it in 16 years. In 2008, when the financial crisis hit, the government could respond with TARP, $700 billion bank bailout, stimulus packages, Fed cutting rates from 5% to 0%, quantitative easing printing, $4 trillion. Why could they do all that? Because debt to GDP was only 65%. There was fiscal space. There was room to borrow and print. Today, debt to GDP is 124%. There's no room left. The ammunition is gone. When the 18-year cycle collapse hits in 2026, the government cannot rescue the economy the way it did in 2008. The debt trap has already sprung. Any attempt to print trillions more will trigger either hyperinflation, Weimar Germany, Zimbabwe, or currency crisis, emerging market collapse, or sovereign debt crisis, Greece, Argentina. For the first time in American history, we're facing a crash with no shock absorbers. The Fed's balance sheet is already $7.5 trillion. Rates are at 4.5%, with inflation still above 3%. They have maybe 150 basis points of cuts before they hit constraints. In 2008, they had unlimited firepower. In 2026, they're shooting blanks. Horseman 4. The consumer credit collapse. The canary is dead. The 18-year cycle doesn't just track real estate prices. It tracks credit cycles, and consumer credit is imploding right now. Auto loans, 6.9% delinquency rate on subprime, highest since 2010. 1.73 million vehicles repossessed in 2024, most since 2009. Average new car payment, $736 month average. Used car payment, $542 month. Credit cards, $1.17 trillion in total debt, all-time record. Average APR above 21%. Delinquencies climbing across all age groups. Charge-off rates, highest since 2011. The underwater borrower crisis, 28% of people trading in cars owe more than the vehicle is worth. They're trapped, can't sell, can't afford to keep. They're rolling negative equity into new loans, creating a debt spiral that ends in default. Here's what this data is screaming. The car payment is the last bill Americans skip before the mortgage. If they're defaulting on cars, they've already burned through emergency savings, maxed out credit cards, cut every possible expense, stopped going to restaurants, stopped buying clothes, stopped everything except survival. Subprime borrowers are the canary in the coal mine. When they collapse, it's a leading indicator that the stress is moving up the income ladder. In 6 to 12 months, prime borrowers follow. This is exactly what happened in 2007. Subprime mortgages started failing in early 2007. It's contained, they said. By late 2007, prime borrowers were defaulting. By 2008, the entire system collapsed. The 18-year cycle's collapse phase always begins with consumer credit breaking. It happened in 1990 with credit card defaults. It happened in 2008 with subprime mortgages. It's happening now with auto loans and credit cards. The consumers are tapped out. And when consumers stop spending in a 70% consumption-driven economy, everything breaks. The cascade, how the four horsemen amplify each other. Individually, each of these four crises could potentially be contained. The Fed could bail out the banks. The government could stimulus package its way out. We've done it before. But these four aren't separate. They're interconnected nodes in the same complex system. When one fails, it triggers the others. They amplify each other in cascading feedback loops that the system cannot absorb. Let me show you the cascade. Cascade Loop 1. CRE. Banks. Credit freeze. Everything. Commercial real estate loans default. Regional and mid-sized banks take massive losses. They hold 70% of CRE debt. Banks tighten lending standards across all categories to preserve capital. Consumers can't get car loans. Businesses can't refinance debt. Credit freeze accelerates defaults across the economy. More CRE losses. Banks fail. Repeat and amplify. Cascade Loop 2. Stock crash. Wealth effect. Consumer collapse. AI bubble pops. Magnificent 7. Fall 40%. Your 401k drops $300,000. You feel poor. Wealth effect. You cut all discretionary spending. Corporate revenues collapse. Earnings miss expectations. Mass layoffs begin. Unemployed people default on everything. Stock crash deepens. Repeat and amplify. Cascade. Loop 3. Sovereign debt. Interest rates. Refinancing death spiral. Debt ceiling crisis hits. Happens every 2 years now. Political gridlock threatens U.S. default. Credit rating agencies downgrade U.S. debt. Already happened once in 2023. Treasury yields spike mortgage rates. Spike to 8 to 9%. Refinancing becomes impossible. Defaults accelerate across all asset classes. Tax revenues collapse as economy shrinks. Deficit explodes. More borrowing needed. Rates rise further. Repeat and amplify. Cascade. Loop 4. Consumer defaults. Bank losses. Credit. Death. Auto and credit card defaults. Spike banks take losses on consumer loans. They tighten lending even more. Fewer loans equals less consumer spending. Less spending equals corporate revenue collapse. Revenue collapse equals layoffs. Layoffs equals more defaults. Repeat and amplify. Do you see it now? These aren't four separate crises happening at the same time by coincidence. They're four parts of the same organism, all failing simultaneously, all making each other worse. This is what complexity theorists call a cascade failure or systemic collapse. It's not linear, it's exponential. In 2008, we had a cascade failure in the housing market that spread to banks, but the government and Fed could step in because only one asset class was failing. Debt levels were manageable. The Fed had unlimited ammunition. The dollar's reserve status was unquestioned. In 2026, we have cascade failures in 4 asset classes simultaneously, with the government drowning in debt, a Fed out of ammunition, and the dollar's reserve status under attack from BRICS, digital currencies, and our own fiscal insanity. The 18-year cycle predicted this convergence. This is the moment when debt, speculation, overvaluation, and systemic complexity all collide into catastrophic failure. And we have no shock absorbers left. The timing. Why 2026 is the trigger year. Let me show you the timeline of how collapses actually unfold, because this is where most people get it wrong. They think a crash is a single day, a Black Monday, a Lehman moment, one dramatic explosion. That's not how it works. The 18-year cycle teaches us that collapses are processes, not events. Here's the typical timeline. Year 16 to 18, the peak prices reach maximum euphoria. Sales volume actually starts declining even as prices stay high. This is the top. That was 2022-2024 for us. Months 1 to 12 after peak. The rollover prices plateau, then start slowly declining. Inventory rises. Days on market increase. Sellers start cutting prices. Media still reports strong market because they're looking at lagging data. This is where we are now, January 2026. Months 12 to 24 after peak. The acceleration. The decline becomes obvious. Panic selling begins. Foreclosures spike. Banks start failing. Stock market volatility increases. The word recession starts appearing in headlines. This is 2026 through early 2027. Months 24 to 36 after peak. The capitulation full-blown crisis. Mass unemployment. Markets down 40-50%. Government intervention. Bailouts. The bottom forms. This is 2027-2028. Let's map this to the 2008 cycle to show you how precise the timing is. July 2006, housing prices peak. February 2007, first major subprime lender, New Century Financial, announces massive losses. August 2007, credit markets freeze. BNP Paribas halts withdrawals. March 2008, Bear Stearns collapses. Month 20 after peak. September 2008, Lehman Brothers fails. Month 26 after peak. October 2008, stock market crashes, down 40%. Month 27. March 2009, market bottom, 57% below peak. Month 32. Notice the pattern? The peak was July 2006, but the crisis didn't fully hit until September 2008, 26 months later. That's over 2 years from peak to full collapse. Most people in 2007 thought the danger had passed. The worst is behind us, said Ben Bernanke in May 2007. The subprime crisis is contained, said the media through most of 2007. They were looking at lagging data while the crisis was accelerating in real time. Now let's map our current cycle. Mid-2024, real estate prices peak in most major markets. Late 2024, early 2025, sales volume collapses, inventory rises. January 2026, you are here, rollover phase, mid-2026 to early 2027, acceleration phase, the danger zone. 2027 to 2028, full collapse and bottom. We're not at the beginning where you can ignore it. We're not at the end where it's already over. We're in the middle, the most dangerous phase, where the rollover is turning into acceleration. The warning signs are already here. CRE delinquencies at 6.6%, 2008 levels. Auto loan defaults at decade highs. Credit card delinquencies rising. Regional bank stocks down 30 to 50% from peaks. Retail sales slowing. Corporate earnings warnings increasing. But the media is still running soft landing headlines. Goldman Sachs is still forecasting growth. The experts are telling you everything is fine. They told you the same thing in 2007. Fred Harrison, the economist who predicted 2008, says the highest probability window for the 2026 crash is mid-2026 through early 2027. Not because he's guessing, because that's what the 18-year cycle says. And the cycle has never been wrong. Destroying the objections. I know what you're thinking. I can hear the objections forming in your mind. Let me destroy them one by one with data. Objection 1. But the economy is strong right now. Unemployment is low. GDP is growing. This is fear-mongering. Unemployment was 4.4% in February 2007. GDP growth was 2.5%. The stock market hit all-time highs in October 2007. Consumer confidence was strong. Corporate earnings were beating expectations. Everyone said exactly what you're saying now. The economy is strong. The doomers are wrong. Then, 12 months later, Lehman collapsed. Unemployment hit 10%. GDP contracted 4.3%. Stock market fell 57%. $10 trillion evaporated. The economy was strong right up until the moment it wasn't. That's how cycles work. They don't decline gradually with plenty of warning. They roll over from apparent strength into crisis. Because all the data you're looking at, unemployment, GDP, earnings, is backward-looking. It tells you where we were 90 days ago, not where we're going. The 18-year cycle doesn't care about lagging indicators. It cares about structural imbalances, debt levels, credit expansion, asset valuations, speculation. All four of those are worse today than they were in 2007, by a lot. The economy isn't strong. It's a Jenga tower missing critical blocks, and everyone's celebrating that it's still standing, for now. Objection 2. The Federal Reserve will just cut interest rates and print money like they always do. They'll save us. Let me show you why that won't work this time. In 2008, when the crisis hit, the Fed had enormous firepower, interest rates at 5.25%, room to cut to zero, clean balance sheet, $800 billion. No inflation, prices were stable. Global credibility, dollar unquestioned. So they cut rates from 5.25% to 0%, 525 basis points of cuts, expanded balance sheet from $800 to $4.5 trillion, 5.6x increase, implemented QE1, QE2, QE3, coordinated global central bank response, and it barely worked. It took years to stabilize. Now look at 2026. Interest rates at 4.5% can maybe cut to 3% before hitting zero bound. Balance sheet already $7.5 trillion, already massively expanded. Inflation still above 3%. Can't print without risking hyperinflation. Dollar under attack. BRICS, gold, Bitcoin competing. They have maybe 150 basis points of cuts versus 525 in 2008. They've already blown up the balance sheet. They can't print without triggering an inflation crisis or currency crisis. The ammunition is gone. And here's the darker truth. Even if they try to print their way out, who's going to buy the bonds? In 2008, China bought $1 trillion in U.S. Treasuries to fund the stimulus. In 2026, China is selling treasuries and buying gold. Japan is selling treasuries to defend the yen. The Fed itself is trying to shrink its balance sheet. There's no buyer, which means rates stay high or go higher, which accelerates the collapse. The Fed isn't a savior. They're a trapped player with no good moves left. Objection 3. This time is different. We have better regulations. We learned from 2008. We have Dodd-Frank and stress tests. That's what they said after 1990. We learned our lesson. We have Basel I banking standards now. It won't happen again. Then 2008 happened. That's what they said after 2008. We learned our lesson. We have Dodd-Frank now. We have stress tests. Banks are required to hold more capital. It won't happen again. Then Silicon Valley Bank collapsed in March 2023, the second largest bank failure in U.S. history. Then Signature Bank failed. Then First Republic failed. 3 major banks in 2 months. The stress tests didn't see it coming. Dodd-Frank didn't prevent it. Why? Because regulations always prepare for the last crisis, not the next one. In 2008, the vulnerability was residential mortgage-backed securities, so they regulated that. In 2026, the vulnerabilities are commercial real estate exposure in regional banks, sovereign debt exceeding 120% of GDP market concentration in 7 tech stocks, consumer debt at all-time highs, $1.5 trillion in CRE refinancing in 24 months. None of those are covered by the regulations designed to prevent the 2008 crisis. The 18-year cycle doesn't care about regulations. It cares about debt, speculation, and overvaluation. We have all 3 in historic excess. Regulations are like building a better lock on your front door after your house already burned down. It doesn't fireproof the house. It just makes you feel safer while the next fire is starting in a different room. Objection 4. Real estate can't crash. There's a massive housing shortage. Millennials need homes. Supply and demand basics mean prices can't fall significantly. They said the exact same thing in 2005-2006. Housing shortage in coastal cities, millennials entering home-buying years, supply constrained, prices can't fall, buy now or be priced out forever. Then prices fell 35% nationally. In some markets, Las Vegas, Phoenix, Miami, parts of California, they fell 50-60%. Supply and demand matter in normal market conditions. But in credit cycle collapses, only one thing matters: can buyers get credit? In 2008, the supply shortage still existed. Millennials still needed homes. The demographics hadn't changed, but buyers couldn't get mortgages. Banks stopped lending. Without credit, there are no buyers. Without buyers, prices fall. Period. It doesn't matter if there's a shortage. If people can't borrow money to buy, prices crater, and in 2026, we're heading into a credit crunch. Banks taking CRE losses will tighten all lending. Mortgage rates likely stay at 7% plus. Down payment requirements increasing. Credit scores requirements rising. Debt-to-income ratios tightening. The supply shortage narrative assumes unlimited credit availability. That assumption breaks when the credit cycle turns. And we're watching it turn right now. The 18-year cycle doesn't care about your supply-demand models. It cares about credit availability, and credit is dying. The Preparation Blueprint: How to Survive and Thrive. The 18-year cycle is not a prediction. It's a pattern. Patterns don't tell you the exact day the collapse happens. They tell you the season. We're in late fall. Winter is coming, and it's coming fast. Here's how you prepare, not to panic, but to survive and potentially profit from what's coming. Step 1. Accept reality. Stop fighting the data. The hardest step is psychological. You need to accept that the cycle is real and it's happening. Stop arguing with 224 years of data. The pattern is 1973, 1990, 17 years, 1990, 2008, 18 years, 2008, 2026, 18 years. It has never failed. Not once. Not ever. You don't have to believe me. Look at the charts yourself. Study the data. The pattern is undeniable. The people who survived 2008 weren't smarter than everyone else. They just accepted reality earlier than everyone else. Step 2. Stress test. Everything. The 40% rule. Ask yourself this question. If every asset I own fell 40% tomorrow, could I survive? If the answer is no, you're overexposed. You need to reduce risk immediately. The 18-year cycle crashes, average 35 to 50% in stocks, 30 to 40% in real estate, 40 to 60% in speculative assets. Plan for a 40% drawdown across everything. If that would destroy you, you're gambling, not investing. Step 3. Build cash reserves. Liquidity is survival. Cash is optionality. Cash is time. Cash is power. You need 6 to 12 months of living expenses in cash or cash equivalents, not stocks, not crypto, not liquid assets that crash when you need them most. Actual cash. Best options: high-yield savings accounts, 4 to 5%, short-term treasury bills, 4 to 5%, money market funds. Do not keep it all in one bank. FDIC insurance only covers $250,000 per depositor per bank. If you have more, spread it across multiple institutions. In 2008, 2009, the people with cash bought people houses for 50 cents on the dollar, bought stocks at generational lows, accumulated wealth that lasted lifetimes. The without cash became forced sellers, losing everything. Cash isn't trash. Cash is ammunition for the buying opportunity of a lifetime. Step 4. Reduce or exit. Real estate exposure. Sell into strength. If you own multiple properties, especially investment properties or commercial real estate, seriously consider selling now. Right now, in January 2026, there are still buyers. Prices haven't fully collapsed yet. You can still get 2023 to 2024 prices in many markets. In 2009, sellers couldn't find buyers at any price. Properties sat for years. Many eventually foreclosed. The window to sell into strength closes fast when the cycle turns. If you own your primary residence with a low fixed-rate mortgage, under 4%, you can probably keep it. You're locked into low payments. But if you own investment properties with variable-rate loans, own commercial real estate, bought in the last 2 to 3 years at peak prices, are highly leveraged, consider exiting now. Take your equity, move to cash, wait for the reset. You can always buy back in 2028 to 2029 at 40% off. Step 5. Eliminate all high-interest debt. Pay off credit cards, 21% plus APR, personal loans, payday loans, any variable-rate debt. The coming years will punish leverage. The most leveraged individuals and companies will go bankrupt first. The least leveraged will survive and thrive. If you have low-interest fixed-rate debt, mortgage under 4%, car loan under 5%, you can keep it. That's manageable. But high-interest variable-rate debt is a ticking time bomb in a rising rate, falling income environment. Step 6. Own hard assets. Insurance against system failure. When paper assets collapse, hard assets hold value. Gold and silver are the ultimate insurance. 5,000 years of monetary history. No counterparty risk globally recognized, can't be printed or inflated away, don't require electricity or internet to have value. Allocation: 5 to 15% of net worth in physical gold and silver. Not paper gold. ETFs. Physical metal you can hold. Bitcoin, if you understand it. Decentralized limited supply, 21 million cap. Increasingly adopted as inflation hedge, high volatility, but potential asymmetric upside. Only allocate what you can afford to lose, 1 to 5% of net worth maximum. Other hard assets: productive land, farmland, commodities, energy, agriculture, essential businesses, cash flowing, low debt. Step 7. Reduce stock market exposure, especially concentration risk. If your portfolio is heavy in tech stocks, concentrated in the Magnificent 7, overweight S&P 500, which is 32% Magnificent 7, holding meme stocks or speculative growth, you're exposed to the worst of the coming crash. Consider taking profits on speculative positions, rebalancing away from concentration, moving to defensive sectors, healthcare, utilities, consumer staples, increasing cash position to 30 to 50% of investable assets. You don't have to sell everything, but reduce exposure to a level where a 40-50% crash doesn't destroy your life. Step 8. Monitor the warning signals. Know when to act. Watch these indicators weekly. CRE delinquency rates, currently 6.6%. If it hits 8% plus, crisis is accelerating. Auto loan delinquencies, currently 6.9% subprime. If it hits 8% plus, consumer collapse is here. Regional bank stocks, KRE index. If it breaks 2023 lows, bank crisis is starting. 10-year Treasury yield, currently 4.5%. If it goes above 5%, crisis accelerates. Unemployment claims, currently stable. If it spikes above 250 cakes week, recession confirmed. These are your early warning system. When these deteriorate faster than expected, the timeline compresses. You need to act faster. Step 9. Develop recession-proof skills. If we're heading into a major downturn, employment will be brutal. Unemployment could hit 8 to 10%. The jobs that survive recessions: healthcare, nurses, doctors, technicians, essential services, plumbers, electricians, HVAC, government, recession-resistant, food production, farming, food processing. The jobs that get destroyed: marketing, sales, HR, administrative luxury goods, real estate, finance. If your job is in a vulnerable sector, start building skills now that translate to recession-proof industries. Step 10. Build community and local networks. The people who survive systemic collapses aren't lone wolves. They're people embedded in strong communities. Build relationships with neighbors, local farmers and food producers, skilled tradespeople, mechanics, builders, medical professionals, people with complementary skills. In a severe crisis, community is infrastructure. The most connected people fare better than the richest isolated people. The opportunity: why collapse creates wealth. Here's what they don't tell you about economic cycles. The greatest wealth transfers in history happen during collapses, not booms. The people who prepared for 2008 didn't just survive, they became wealthy. Real estate: houses that sold for $400,000 in 2006 sold for $180,000 in 2011. Investors with cash bought 5 to 10 properties at the bottom. Those properties are now worth $500,000, $600,000 each. That's generational wealth built in one cycle. Stocks: S&P 500 fell from 1,565 in October 2007 to 676 in March 2009, 57% crash. Investors who bought at the bottom saw a 600% return over the next 12 years. $100,000 invested in March 2009 became $600,000 by 2021. Distressed assets: foreclosed properties bought for $0.30 or $50 on the dollar. Failed businesses acquired for pennies. Distressed debt bought at massive discounts. The pattern is clear. Collapses destroy the unprepared and create wealth for the prepared. But you have to do two things: survive the collapse with capital intact, have the courage to buy when everyone else is panicking. That's why preparation isn't about doom and gloom. It's about positioning yourself to capitalize on the greatest buying opportunity of your lifetime. Let me leave you with this final thought. The 18-year cycle has never failed. Not in 1837, not in 1873, not in 1890, not in 1907, not in 1929, not in 1973, not in 1990, not in 2008. Every 18 years, like clockwork, the credit cycle collapses, real estate crashes, stocks crater, recessions follow. The people who studied the cycle and prepared survived and thrived. The people who ignored it lost everything. Fred Harrison predicted 2008 and 2005. He was mocked, ridiculed, called a fearmonger. Then he was proven exactly right. He's predicting 2026 now. The data supports him. The cycle supports him. History supports him. You can argue with him. You can argue with me. But you cannot argue with 224 years of data. The cycle doesn't care about your feelings. It doesn't care about your politics. It doesn't care about your hopes for a soft landing. It doesn't care if you're ready. It just repeats. 1973 plus 18 equals 1990. 1990 plus 18 is 2008. 2008 plus 18 equals 2026. The math is simple. The pattern is clear. The countdown is over. 2026 is when everything breaks. The question isn't whether the 18-year cycle will play out. The question is whether you'll be positioned to survive it or profit from it. The people who prepared for 2008 didn't just survive. They bought assets at 50 cents on the dollar and became wealthy. The people who ignored the warnings lost their homes, their savings, their retirement. Many never recovered. This is your 2007 moment. The warnings are here. The pattern is flashing red. The cycle is rolling over. You can believe the experts on CNBC saying soft landing and no recession in sight. The same experts who missed 1990, missed 2000, missed 2008, and will miss 2026. Or you can believe the 18-year cycle, which has never missed. History doesn't repeat, but it rhymes. And right now, it's rhyming with 2007. The 18-year cycle just completed. The collapse phase has begun. 2026 is when everything breaks. The only question left is, will you be ready? Subscribe if you want to survive what's coming. The next video breaks down exactly which assets survived the 2008 crash and which got destroyed, and how to apply those lessons before the 2026 collapse accelerates, because the cycle is inevitable. But your response isn't. The clock is ticking. The pattern is screaming. The cycle never lies. Are you listening?